Is this the bottom of the market? Let's talk about data that just came out today. But first, to understand the data that just came out today, we have to remember and catch you up with what the Federal Reserve told us was going to mark max pain. The Fed, in their last meeting with Jerome Powell, last FOMC meeting, made it very, very clear that inflation itself is no longer the only goal. Driving inflation down isn't the issue right now because what they believe is in order to drive inflation down, they need there to be less job openings, because when you have fewer job openings, people are less motivated to change jobs. That is, quit their current job, and that's not counting retirements. Those are counted separately from quits. But anyway, when people are less motivated to quit their jobs, then they stay at their current jobs. And we know that quits and then getting a new job usually leads to wages going up. Not always, depends on the market. But if less people are quitting, then less people are moving to new jobs, potentially or likely getting more pay. And getting more pay means we're seeing wage inflation. And that's exactly what the Fed has decided. We really need to stop this wage inflation because we could create a wage price spiral. Now, if you've been watching my channel since at least this January, where I first said we're about to go through a hellish 2022, and I did some selling, okay? No shame in that. But I got a super restore potion here. I said, look, the biggest danger we have in the market is a wage price spiral. And generally, a wage price spiral occurs when the rate of wage gains is higher than the rate of inflation. Say my cup is where inflation is. If wage gains are here, we got a problem. In January, we had wage gains that were higher. They were later revised down, but they were higher than inflation. It's like, oh my gosh, this is the start, right? But then what ended up happening this last meeting is the Fed made us realize that, hey, look, inflation might be at 8% and job inflation might be at 6.5%. Let's just say, right? I think inflation is like 8.3 or whatever. But anyway, but if inflation falls quickly to say 5% and job or wage inflation is still at 6 or 7%, we have a wage spiral. A wage spiral is where what people demand for pay goes up, so they get paid more. That increases costs for businesses. When costs for businesses go up, they have to raise their prices, which they can do as long as they have purchase or pricing power. And then they raise their prices. But then things get more expensive, so employees start demanding more pay, and you kind of get this stair-stepping increasing of wages, products going up, wages, products and services going up, right? And you get these price increases. That only works until something breaks. Generally, the first thing that breaks is people's PP goes away. That is, the pricing power that companies have goes down. So there's a limit. And when wages are going up and pricing power, like you can't raise prices anymore because you're maxed out on your consumers, and pricing power goes down, or you start cutting. And you see this, what you're really doing is compressing company margins, their profits, right? And so the Fed made it really clear that, look, we might actually see wage inflation surpass regular inflation. And that's really, really bad. So we are flip-flopping again. And by flip-flopping again, what we're going to do is we are now going to say that the most important thing going forward is jobs. Well, what's interesting is we got some jobs data this morning, and I'm saying that as you see me hold a newspaper, which implies that it's old news. And that's somewhat true because the jobs data that we're going to talk about is not in this newspaper. But there's something else that's in this newspaper. This is the New York Times, by the way. They don't like me, okay? They call me a landlord influencer and like to bag on me. I'm not even a landlord right now. I do have a real estate startup that will be a landlord, househack.com. If you're an accredited investor, check it out. Go to househack.com. We're accepting accredited investors, and you get the most basically free call options if you join by the end of the month. So check that out. Send in your CPA or attorney letter, or get an accredited investor letter at househack.investready.com. Okay, so I'm going to read you some parts of this because it's really, really important to help us understand, could we potentially be at a bottom of the market where the market is now saying, okay, well, the pressure on the Fed to keep being so aggressive is starting to go away. That means the Fed's more likely to U-turn, which means maybe we'll align with the bottom of the market. Because remember, the bottom of the market almost always, at least historically, has aligned with when the Fed's U-turned. 89, 2003, February of 2009, December 2018, and March of 2020. Those were all Fed U-turns. Those were all the bottom of the markets. Now, because we're so aware of that, we're trying to price in the bottom before the Fed actually U-turns. So it wouldn't surprise me that the market's already 10% higher when the Fed actually U-turns. But anyway, well, and that's why we spend so much time studying, like, all right, well, how are things changing, right? So listen to this. I'm just going to read this, like some little parts here. So here's a home furnishing company that last year in North Carolina was so desperate to hire people, they basically paid for a billboard and offered $1,000 signing bonuses. And they were trying to ramp up their hiring, right? But they couldn't find anyone. In fact, they said, we just couldn't get labor fast enough. And the reason for that is because people were leaving to other jobs, which generally when people leave to other jobs, they get paid more money. Now, this furniture company says, quote, no one is really chasing employees to the dollar anymore. Now, they do go on to say here that the labor market's obviously still strong, but it's actually getting a lot easier to find people, and less people are quitting. And this is going to align with some of the numbers that we see this morning, which is really, really cool. But we also know that obviously like Facebook and Google, Apple, Tesla have either stalled hiring or started laying people off in certain segments. FedEx has frozen hiring altogether. And listen to this from the article here. Wage growth, which soared as companies competed for workers, has slowed, particularly in industries like dining and travel, where the job market was particularly hot last year. The labor force grew by more than 750,000, so 750,000 people in August, the biggest gain of the labor force since the early months of the pandemic. That's a big inflection point, right? Because you get the biggest gains at the beginning. Some executives expect hiring to keep getting easier as the economy slows and layoffs pick up. With inflation still high, weaker wage growth will mean that more workers will find their standard of living slipping. So obviously it's not good for like lower income workers, but it's good for the Fed, right? Because this kind of slowdown would lead to less pressure on the Fed to keep aggressively hiking rates. The decline in voluntary departures was particularly notable because so much recent wage growth had come from workers moving between jobs in search of better pay. Recent research has shown that there's been a huge increase in poaching, companies hiring workers away from other jobs during the recent hiring boom. But that is becoming less common now. That was actually research from the Fed Reserve Bank of Dallas and St. Louis. And listen to this. There are hints that could be happening. A recent survey from another career site, ZipRecruiter, what could be happening is basically less people quitting, right, and less job openings. A recent survey from another career site, ZipRecruiter, found that workers have become less confident in their ability to find a job, and we're putting more emphasis on finding a job they found secure. Workers and job seekers are feeling a bit less bold and a bit more concerned about the future availability of jobs. Some businesses, meanwhile, are becoming a bit less frantic to hire. A survey of small businesses from the National Federation of Independent Businesses found that while many employers still had open positions, fewer of them expected to fill those jobs in the next 3 months. In other words, there's less pressure on making sure they absolutely fill those jobs. So this is really good. And it actually aligns with data that we got this morning. Here's what we got this morning, folks. This chart is a chart of the JOLTS Job Opening Index. It tells us how many job openings there are. We actually, Jerome Powell regularly told us that right now, or when we were above 11 million, so sort of in this territory right here, we had about 1.9 to 2 jobs available per unemployed person. And Jerome Powell told us this summer he wants to see that ratio to be 1 to 1. In other words, if we have 6 million unemployed people, we want the JOLTS to be at 6 million. That would be a sign of less wage inflation, which would mean the Fed could take the foot off the gas in terms of hiking rates, and we could relax. Now remember, the Fed always cautions that we can't just use one report and say that, oh, that's it, game over, bottom of the market is in, Fed is done. We can't do that because as with inflation, what we thought peaked in March didn't actually peak until June. We thought the JOLTS were going down earlier this year, but then they actually increased, right? Let me show you that chart again. I just want you to see, because this is why it's so important to understand, like, One report's not enough. See, look, we went down from the peak, fall, oh no, increase, and then we got our sharp decline. So the point is these numbers can be volatile, but let me give you the numbers that came out this morning because they're actually pretty good. So the expectation for how many job openings we were going to have was 11,088,000 jobs. Last month, so 11,088,000, okay? Last month, we were about 200,000 jobs about that, at 11.239 million. So what they did is they actually looked back at last month and revised last month down by 69,000. So there were actually less job openings than they thought last month. Then the expectation for this month was 11 million, but we actually came in at 10. Let's go. Finally, we're seeing an inflection point. Finally, we're seeing some signs towards the bottom. Now, we can't call it a bottom, even though there's so many indicators suggesting that inflation's going to be falling, so many indicators suggesting that commodity prices are absolutely collapsing. For example, I was looking at, I don't think I have it up right now, but let me see if I can find it. The HSBC put together their global economic outlook, and it's a really good read, but it's really, really dense. But I'll just give you a quick example of just one of the pages here. So here, this is just like number 30, chart 30 and chart 31. I mean, this is like, I read this kind of stuff. This is literally 118 pages long, okay? Like, I don't watch other YouTubers. I just try to give you proprietary info here. And look at this. Supply chain pressures plummeting supply chain pressures. You could see that on the left chart there. Shipping costs plummeting on the right side. They're still elevated, right? They're still above where we used to be. But the point is, some of these things that were dramatically increasing costs are starting to decline. Now, we know that global inflation is still sneaking up, and that's the dangerous part, right? But when that's represented by these lines around the world right here in chart 27. But we're starting to see, and I hate using this phrase, but hope. And remember, hope is not an investing strategy, but we're starting to see some signs, and it's really good. So I'm very, very happy about that. Now, look, if you want to invest with me and House Hack and buy deals when this real estate market continues to suffer pain, and you want to get deals below market value, learn about House Hack. Whether you're accredited or not, learn about House Hack. Go to househack.com. If you're not accredited, you'd have to wait until about January to invest with us. But if you are an accredited investor, you can get up to a 60% in free, basically call options on the company with your investment. Read the PPM for a full explanation on that. If you're an accredited investor, just send us a CPA letter, an attorney letter, a broker letter, or get a letter from househack.investready.com. Submit that after you have your letter by going to househack.com, filling out the form, applying. Minimum investment's $25K. We'd love to have you. We're at almost 30 million raised in less than 30 days. So we're very excited about that, and we'd love to have you. Thanks so much for watching. We'll see you in the next one. Goodbye.